Good evening, my fellow stock market drivers and my fellow spy traders. Hope you had a nice weekend. Let's just take a look through the markets here real quick. Maybe not real quick, but 10 or 15 minutes, just to see what's really important to watch this week. And I think the market is going to continue to go lower now. Those of you who listen to me know I've been saying this basically since the market topped a few weeks ago. But based on those really high sentiment readings, it was, I don't want to say it was easy, but I'm not surprised that the market has gone lower. So anyway, let's just check this out here. 10-year yields. These are the highest they've been since October of '07. So we're talking about 15 years ago. High interest rates are bad for the market, for the stock market. There's a couple reasons. One is firms that leverage to trade are going to get less leverage because leverage is borrowed money. And if you have to borrow it at a higher rate, you're going to borrow less. Two is this gives the stock market competition. It's like, all right, well, we're yielding 4.3%. Should I go into the bond market, get a guaranteed income, or do you stay in the stock market? Probably the most important reason, though, is that the higher the interest rates are, that money comes right out of the bottom line because companies don't take money out of the cash register to pay their employees and pay their operating expenses. They borrow in what we call overnight agreements or short-term money market this, that. I mean, there's so many different things. But the bottom line is this: it's costing them more money to borrow than it was before. And that comes right out of the bottom line. It's kind of interesting here as we always talk about our levels. Remember, this is the inverse of the bond. We're looking at the yields here. So if we go invert, look at this: support, support, resistance, resistance. It makes sense. Markets are determined by mostly technicals and psychology. It's not the stuff they're talking about on CNBC or whatever the news story du jour is. All right, let's go just take a quick look here through SPY. Now, SPY is the S&P 500 ETF, which tracks the S&P 500 and is very popular, very highly traded or widely traded, highly traded. I guess you could say the same thing. Now, we got the inverted here, so let's go to regular. All right, so here is SPY. Now, I would not be surprised to see us get to around 431 and then have a bounce. Why does that happen? All right, well, it's because of psychology. It's all about psychology, everyone. Don't think that there's like a secret system that people can use and the hedge funds or the market makers have these, like models that are always perfect. And I know because I was a hedge fund trader and I was a market maker. So I can speak with authority. Not too many things I can speak with authority, but that's one of them. At least that's what my kids tell me. All right, anyway, so we had resistance back in last August, so a year ago, around 431. What happens up here? We get a little bit of sell-off. We get resistance at 431. How could this happen? How is it possible that a level that was resistance a year ago became support a month ago? Well, if you don't think in psychology, in the terms of psychology, you'll never be able to explain it or understand it. But if you do, it's pretty easy. There are people who bought back here, and when the price goes higher, they're like, I regret selling. I regret buying when the price goes lower. If it gets back up to my price, actually, let me start again. Okay, so there are people who bought back here I'm going to start again. There are people who sold back here. Okay, now I got it. People who sold back here who thought they did a great thing, but when the market went higher, a lot of the people who sold, remorseful sellers, tell themselves, I made a mistake. I'm going to buy my shares back if I can at the same price I sold them at. So the whole time here, they're like, wow, man, I'm easy. This is easy. I'm going to make money as a hedge fund trader. But then the price goes higher. Like they want to buy their shares back. So if you have enough remorseful sellers placing buy orders, the level that was resistance becomes support. Now, why is it that levels bounce off of support or markets bounce off of support levels? You have these investors who want to buy, and they notice the prices stopped going lower. And markets go lower because there's not enough buyers. If they stop going lower, well, then you can make the assumption that new buyers are coming into the market. So some of these investors who want to buy are like, man, I don't want to miss out. So I better increase the price I'm willing to pay because the sellers are going to go to whoever is willing to pay the highest price. So someone might be at 431 and someone else might say, okay, you're 431. I'm going to go to 431.20 to bid. Someone else might say, all right, I'm bidding 431.50. I'm bidding 431.60, so forth and so on. And that causes the bounce. So this is why markets bounce off of support. Most of the time, I would say the vast majority of the time, when markets are making moves, it's because of important technicals. There's very few news stories that actually affect the price of the market. Basically, things that have to do with interest rates. Other than that, that's it. We got to understand these news organizations are really just paid to entertain. They really don't give real analysis. And frankly, I think that most of the journalists really have no idea what was going on. Like, I was watching Maria Bartiromo last week, and I really like her, but she had some guy on, and his name was Brian something. I don't know what his last name was, but he was like, yeah, there's no traders in. It's just the algos bringing it up and down. And it's like, dude, if there's no trader there to hit the enter button on the algorithm, it's like what do you think? These algorithms just kind of materialize out of nothing and just start trading? It just shows a lack of understanding of how Wall Street really works. Algorithms are just tools traders use. To say that, oh, the market was moving, but no one's around, it's just the algos. It's like saying, oh, I was down at the construction site and, the hammers were hammering, but there are no carpenters there. All righty, now let's just go look at tech really quick. There are 11 different sectors in the S&P 500, and SPY is an ETF that's run by State Street. So if we type in the symbol, SPY, SSGA for State Street Global Advisors, this can bring us up to get the fact sheet. It's very cool stuff to know. Free, and if you're trading SPY, you should probably know this stuff. Now look at the holdings. We got 11 sectors. Tech is the biggest, healthcare is the second biggest, financials are the third biggest, consumer discretionary. Different things are in the driver's seat at different times. And by watching these various sectors, it can give you good insight into what's going on in the broader markets. Now, real estate, utilities, and materials, they're all about 2.5%. So they're not really going to have an effect on the market. Energy is about 4.5%. But energy affects everything. So sometimes you can get insight into what's going on in the rest of the market by watching energy. Consumer staples is small too, but sometimes right before the markets sell off, money flows into consumer staples because it's perceived to be safer. Notice I say perceived and not is, but perceived to be safer than the rest of the market. So by watching these sectors, it's kind of like we're going beneath the hood and we can get an idea of what's going to go on in the broader markets. So the biggest sector is our tech sector. Let's just take a quick look at that. And playing with the level that was support, there tends to be support at former support levels because there are investors who sold, who regret doing so when the price goes higher. And they're like, damn, man, I made a mistake. I want to buy my shares back. So if you have enough remorseful sellers trying to buy their shares back, the level that was resistance converts into support. And also here, if we have a support level, seller's remorse can keep support intact as well. So not only can seller's remorse convert resistance into support, it can keep support intact. So let me just say that again. Here we have sellers who sold, and when the price goes higher, they regret doing so. They tell themselves, I made a mistake. If I can, I'm going to buy my shares back if they get to the level I sold them at. So if you have enough remorseful sellers placing buy orders, what was support can become support again. Here you have the opposite. People sold here, and the price goes higher, and they regret selling. So it's a little different. Seller's remorse can turn resistance into support, and seller's remorse can keep support. These charts have to be looked at through the prism of psychology. I mean, look down here. Resistance becomes support, resistance becomes support, resistance becomes support. See, I'm not making this up, man. You can see it almost like any chart. Now, why would a level that was resistance become a resistance again 18 months later? Well, this is our buyer's remorse. People bought back here. They regret doing so when the price goes lower. A lot of them tell themselves, man, if I can get out of this at break even, I'm going to. So a year and a half later, the price gets back up there. You got remorseful buyers trying to sell. Seller's remorse can keep support intact. Buyer's remorse can keep resistance intact. Okay, and here we see buyer's remorse turn support into resistance because we got remorseful buyers trying to get out of break even. Same thing happens down here. The moral of the story is, everybody, if you really want to learn how to read charts and how to make money by reading them, because that's what we're all here for, you just got to look at it through this prism of psychology. You could ask not any, but the vast majority of investment students or professors, how is it possible that support here became resistance here, then became support here, and became resistance here? How is it possible that support down here became support here? How is it possible that resistance here became resistance here? If you look at this sector, which is worth trillions of dollars, the financial sector, from a traditional investment, income statement, price to earnings ratio type of point of view, you're never going to figure this out. But if you say, oh, I don't care what they're saying on CNBC. I don't care what this analyst here is saying. I don't care what this analyst is saying. What I care about is what is the market saying. And markets talk to us by how they act when they get to important levels. So just say you bought down here. Oh, where should I sell? I'm going to sell at 36. Well, guess what? You would have missed out. But if you let the market talk to you, oh, there was resistance around 30 and a half. That's probably where there's going to be resistance again, because there are people who bought there who are going to be trying to get out. So instead of missing it, because you're just pulling a number out of the air, you could put your sell order around here. Knowing where these price levels are helps you decide where your targets are going to be, and helps you know where you're going to buy. So you're thinking about buying a financial stock, a bank, an insurance company, whatever, and you see the market's in free fall, and it's like, oh, where should I buy? Oh, look at that. There was support around 31 for the financial sector. I'm going to just watch the market go lower. And when XLF gets to around 31, that's where I'm going to pull the trigger and buy. So the best traders, they let the market tell them what to do. It's important to understand that some price levels are important than others. And these levels are called support and resistance levels. Support and resistance can stay intact for a long time, or they can shift back and forth from support to resistance and resistance to support. This is what we call market memory. Okay, everybody, thank you so much, and I hope to see you this week.